Hello guys, you're welcome to ANC Stock Investment Limited, the number one partner to FX Promos. Today I'll be walking you into a full course on Forex. What is Forex? A lot of people keep asking, what is Forex? And a lot of people have even termed Forex as gambling. But today I'm here to open you or take you into walk into this mighty opportunity that I believe can change your life because it has changed my life. So what is Forex? As a lot of people may be thinking that Forex is gambling, I'm here to tell you today that Forex is simply another form of business. And if you treat it as a business, then you can make profits in the long term or a short term. A lot of people have taken Forex as side hustle. A lot of people have taken Forex as their career. I, for one, this is my career. And so today I'm here to take you to walk into this market, what it is, how it operates, how you can make money from this market, and the opportunities that are installed there for you. So stay tuned as we move on. So guys, this is a market that can change your life, as I earlier said, and I will be walking you into this market, showing you the different opportunities, the different strategies on how to make money or how to get into it. So let's dive directly into this. So what is Forex? An introduction to the Forex market is going to open your mind in the different ways that you can make money. It's going to open your mind to the participants in the Forex market. It's going to open your mind to the opportunities in the market. So like we say, Forex simply is the buying and selling of currencies in terms of another. For example, when moving from Cameroon to the US, you need to convert your CFA into US dollars. In that process, automatically you have participated in Forex trading. Now, how can you make money from this process? We have key players in the Forex market known as the banks. We have key players like the politicians, we have the economy, and so on and so forth. So then how can you make money from this market? At the point in time where you had to convert your CFA into US dollars, for example, you practically had to convert 550 francs for $1. And in terms of returning back from the US, maybe the value of CFA may have dropped or have gone up. Let's say since you converted earlier at a price of 550, on coming back, let's say you had to convert now at 560. We have 10 francs automatically that has gone up into the money. In that process, it is just by you buying the US dollars and holding, and in value, let's say we have valuation of the currency, which has actually increased the price of or the value of that currency by 10 francs. Automatically, you're making a profit of 10 francs. Now, this has been brought to us in a digital world where you can sit just with your phone, you manipulate your phone, carrying out the practicalities of this time life activity right down by simply using your phone with the help of a broker. Now, who is a broker? A broker is a middleman between the banks and the retailers or the traders in any economy, because these are the policymakers. These are the people that link one person to another. You can be a broker, you can be an introductory broker, so we have different brokerage activity, but I'll take you then into another step. So what are the benefits of Forex trading? It is the most liquidity market in the world. We have currencies are always fluctuating, which creates trading opportunities. Now, because currencies are fluctuating, you have the opportunity to buy and sell at every point in time. Let's say, for example, you are buying US dollars at this particular point in time. Meanwhile, in another country, another person is selling that same US dollars. At a point in time, all currency pairs in the Forex market are always in two. That is, if you're buying CFA, automatically you may be selling US dollars. Now, we have the Forex is not correlated to other assets. It is the most liquidity market in the world because people keep buying and selling at every point in time. It operates 24 hours a day, 5 times a week, which means at any point in time in the world, any place in time in the world, you can actually trade the market just with the help of the internet connection. We have how currencies trade in the Forex market. Now, currencies are traded in pairs. As I earlier said, because the Forex market is a liquidity market, At every point in time, once you are selling a particular currency, automatically you buy another currency. When you're converting your currency to go into the US, automatically you're buying US dollars into the CFA ring. So the price represents how much quote a currency is needed for or to buy another currency. Let's say this is in a situation where you're actually converting your CFA 550 francs into $1. That price set for that conversion is actually the price you pay to buy the US dollars. We also have, e.g., the Euro USD trade at 1.3900. These are actually different terms that you can actually use in the forex market. But without taking much time, I will be walking you into the root of the matter, which we are going to be looking at how possible you can start making money in this market. So why are currencies in pairs? Now, currencies are in pairs as one currency is bought while others are sold. For currencies to actually make profits in the market, just like every other business, you need to exchange your fiat currency to either get a particular product. So in the forex market, just at the time where you're exchanging your currency in terms of another, you must make sure that you're getting something in return. Maybe another currency, or in return, maybe another currency. Now, there are major currencies in the forex market. Just like there are key economics, like we have Japan, we have USA, we have China, and so on. These are different countries in the world that actually hold the world's economy. So when they say yes, it actually affects the economy. Just like we can see Donald Trump making speeches and currencies are taking changing values. It is just the same with the market because we have both fundamentals and technical analysis. So currencies here have major or minor currencies. For example, all currencies that are linked to the US dollars are major currencies, while all other currencies that are not linked to the US dollars are minor currencies. These are key things you need to understand in the market, because as you ride on into the market, you need to take time to actually understand, to see how you can actually practicalize all what we are looking at. So what are pips? Now, just like every other business, there are key aspects you need to understand. Now, a pip is a unit calculated using forex traders, or that help forex traders calculate the amount of profits they can make per trade. Like I said before, I'm going to break this down to the lowest level for you to understand. Now, at the point in time when you are actually selling your CFA to buy US dollars, that spread, the difference between that transaction is actually your profit. But now, in real terms in the forex market, we call that a pip. It is the major difference between the process of converting your CFA into the US dollars. So as forex traders, as you enter the market at every point in time, that difference between the CFA and the US dollars is known as the pips. And before you enter the market as a trader, you should already calculate your number of profit, or the amount of profit you want to make per trade, which your pip is there to help you. Now, we shall not take a deep look at how to calculate pips on this particular course, because we shall look at it when we look at the fundamentals and technical analysis of forex trading. We also have the bite, we have the offer, and we have the spread. These are key terms in the forex market that helps you interpret whatever decision you want to take in the market. For example, a buy is what you will pay to buy a particular currency pair. And in this term, like I said, when buying your currency pair, you need to already know how much you make in that particular transaction. While an offer is what you offer to be able to sell a particular currency pair. As I said, currency pairs in the forex market are always in two terms. We have the exchange in terms of another, which is the currency you as the forex trader hold, and the one you are offering to get the exchange in terms of. So, for example, we have the Euro USD currency rate. These are different currencies. Just like to understand how a spread will work or a pip will work in any forex trading analysis, you need to be able to understand the spread. And like I said, the spread is the same as the number of pips you can calculate and which helps you make or map out your profitability in each trade you make. Now, what is leverage? A lot of people keep blowing accounts in Forex market because they take a lot of leverage. Leverage is the ability in the market where a broker gives you a higher possibility to borrow money and do trading. Now, it gives you the ability to be able to take what is known as a lot size. A lot size is that power that gives you the ability to be able to make fast returns on your trading effect at every point in time. So, a low leverage will give you a low return per trade, while a high leverage will give you a higher return per trade. It works in correlation with your lot size. Leverage are almost the same like lot sizes. So when you leverage a high amount, automatically you are going in for a high lot size, which is going to give you a higher returns on your trade per second or per minute. We have other major definitions in the Forex market that you need to understand. For example, we have stop loss and take profits. Before you enter the market, you already need to calculate your level of risk. Now, just like every other business, there is a risk tolerance you need to face before taking a decision. And this is where a lot of people fail because they'll fail to understand that just like every other business, we have risks. And for you to be able to make a lot of profits in any other business, you need to be able to take a minimum or a maximum number of risks. And you need to calculate these risks before setting into the market. That is why the aspect of stop loss and take profits come in. This is to tell us that before venturing into the market, you should already calculate the number of risks or the amount of risks you are willing to risk, let's say per capita, to gain your profit. So the stop loss and take profit comes into play major significant aspect in your trading life or trading career. Now, you should be able to calculate the amount of money you want to lose before entering a particular trade. Just like you calculate the amount of profit you want to make per trade, taking a stop loss will minimize the losses you make per trade, and taking a take profits or a take profit will either tell you the exact amount you want to make per trade. Now, just like a scalper, just like a swing trader, and many other traders as you can name as per se, you will always need a stop loss to be able to maximize your profitability in the Forex market. I always tell people, never take a risk without maximizing the tolerance of that risk, and never enter a trade without taking a take profit or a stop loss, because these are key things that will help you. We have the margin call, which is the amount of money secure per position. Every margin call, for example, as a trader, as you trade every day, once your liquidity or your equity in your account is below the required margin, automatically the broker you're working under sends you an alert that your account is at risk. And at that point in time, a lot of people never know what to do or which step to take, because it actually signifies that you can blow your account at every point in time. So you should be able to manage your margin call, or let's say know the maximum number of trades you can place per account at every point in time, because this is going to help you maximize your risks for better returns in the Forex market. We have tradable instruments. Just like every other market, we have different assets or different products sold in the market. For example, if you enter a supermarket, you have a whole variety of different products sold in that market. Just like in the financial market, we have different currencies, we have different assets such as gold, silver, and you can name the rest, wheat and rice. So in the Forex market, we have different assets that are being placed, and it is you as a trader or you trying to build your life in the financial market that needs to determine which area to fall in the market. So before we get there, I would like you to look at this. Hello guys, you're welcome back. I believe this is an amazing opportunity, and from our previous model, I do hope you actually grab a lot of things. And we shall be moving right now into one of the key aspects in the Forex market known as charting. Now, charting is the ability for you to be able to look at the charts, tell what will happen in the future. This comes with a lot of attention. It comes with a lot of work. It comes with a lot of understanding and of details in the market. So right now, I'll be taking you into market volatility. What is market volatility? Market volatility is a measure of how much price of a financial instrument varies over time. Just like in every economy, we have inflation and deflation. In this aspect of volatility, we look at how currencies rise and currency falls at every point in time. This comes with a lot of intake where we'll be looking at fundamentals and technical analysis in the financial market, which are the main pull streams that you need to understand to take decisions on buying or selling a particular currency at every point in time. So volatility is a measure of risks and market trends that can actually use to predict the market direction. With volatility, you look at fundamental analysis, you look at technical analysis. For example, we have the economic political activities that keeps affecting the market every day. When Donald Trump makes a speech, as I say, it affects the volatility of the market. When political activities are being taken upon in a country, it affects the market. When we have economic activities such as war, it affects the market. All these are wrapped up under the volatility in the financial market. So we're moving directly into what is known as charting. Now, introduction to technical analysis. Like I said before, as we move to charting, you are going to understand what technical analysis is. Now, in the financial market, we have key things that you need to understand. For example, we have the charts that are one of the main key things you need to understand how to read. So, introduction to technical analysis. What is technical analysis? A lot of people are asking. Technical analysis is simply the review of past activity to predetermine future moves in the market, and this is with the help of a chart. We have indicators, Forex indicators, and we have theories. All these are different aspects in the market that will assist you to be able to make decisions. So, introduction to charting. What is a chart? A chart is simply a measure instrument used to predetermine the activities or moves in the market at a certain point in time. And in charting, we term it technical analysis because we look at past events to predetermine the future moves in the market, if it will be going up or down, rising or falling, bearish or bullish. So we have different trends, we have different activity that keeps take or that will influence the market at every point in time. So for example, as we move into charting, the first thing we need to understand what charting is all about is a trend. A trend is simply a direction in the Forex market. A trend, we can have an uptrend or a downtrend, bearish or bullish momentum in the market. So the first thing we are going to be looking at is there are three main types of trend. We have uptrend, we have downtrend, and we have sideways trend. An uptrend or an uptrend is defined as a series of consecutive higher peaks and troughs. That is, it is a consecutive movement in an upward trend in the market. For example, as we can see here, this is an uptrend. It is consecutive in the sense that it keeps moving up and up and up at every point in time. We also have a downtrend, which we are going to look at. A downtrend in this term indicates a downward movement in the market. At this point in time, a lot of people are selling, while previously with an uptrend, we see how a lot of people will be buying. So the market at every point in time have different opportunities that you can actually make profits from. So as we said, an uptrend is actually an upward movement in the market, where a downtrend is actually a downward movement in the market. We have these different candlesticks that will always help you to predetermine what step to take in the market. So we have a support and resistance in the Forex market. These are key things that every trader needs to understand. Remember, I said we have an uptrend and downtrend. Now, uptrends and downtrends have what is known as support and resistance. Support and resistance are key decision points in the forex market. As a trader, or let's say as a forex trader or a stock trader, you should be able to understand support and resistance, because these are entry and exit points in a professional forex life cycle. For you to make profits in the forex market, you should be able to determine an entry point or an exit point. And support and resistance are those key points that enables you to be able to determine your entry and exit points in the market. So we have a support, resistance, which are terms used by technical analysts to indicate likely ends and trends in the forex market. So support refers to a certain price level on a chart at which a falling currency pair encounters a resistant market. Let me break this down. Now, we have a support point in the market, just like we previously saw in our chart. This is a downtrend, and in every downtrend we have a resistance point, while in every upward trend we have support points. Now, I'll be moving directly into how you can identify support and resistance points. Now, we are talking on a support level. A support level is actually the measure point where we encounter a break in the market, and it is actually a play where we predetermine from there if the market is going to change its direction or change its directions or maintain a persistent uptrend in the market. So let us take a detail of what an uptrend is. Support and resistance are different aspects in the market, and we are looking at a support point. So if you look down here, we have key support points and key resistance points. Now, a support point is a measure point that breaks or resists a downward movement, while a resistance point is a key point that actually resists an upward trend. In the forex market, these are key entry and exit points that you as a trader need to understand, because if you enter the market at an up point, then you may be doomed to come out with a losses or blow your account. But if you enter at a striking point, making profitability is all what you need. This is where a lot of traders have failed, because they fail to understand the entry and exit, support and resistance point in their trading life cycle. As we move on, I will be taking you deeper and deeper into this course for you to have a better wrap up and understanding of the market. You're welcome back, guys. Just like I said earlier, for you to actually make money in the forex market, you should be able to understand your entry and exit point. And the reason why a lot of traders keep blowing accounts is because they fail to understand this fundamental principle in the forex market. Your entry and exit points are those points that determine your level of profitability in the market, be it a long-term trader or a short-term trader. For example, each time you enter the market or each time you want to take a particular trade in the market, never you enter a trade at a trending without identifying the support, resistance, or the breakout of that particular currency pair. So like I said before, we are going to go deeper into this particular course. So simple moving averages. Now, a lot of people like trading using different indicators. A lot of people like trading using different patterns, but I, for one, I like trading without any indicator. It is my own trading lifestyle, and it is that lifestyle that has led me to this level, and it is what I like passing on to every person I mentor. So for some reasons, I would just like to brief you on what a simple moving average is all about and how you can use it. So a simple moving average is simply the average price, usually the closing price over the last period. It is a closing price over the last period. It is a difference between the your entry point. Remember, before you enter the market, you are always at a certain particular point in the market. So it is the closing price of that period before you enter the market. It is historic in different aspects. So you should be able to look at your past history to know how the market has been moving in a volatile dimension to be able to determine where to enter. And your simple moving average would always guide you over that. We have head and shoulders. Just like I explained on the support and resistance point, the head and shoulders are those key dimensions that you also need to take in simple, that you also need to understand how they play before you enter the market. Because most of the time, the head and shoulders play the same as support and resistance level in trades. So this is a formation which is characterized by two small pegs on either side of a larger peg. For example, here we have the left shoulder, we have the right shoulder, and we have the head. At this particular point in time, now as you get deeper into the Forex market, each time you see a move like this, it signifies a longer fall in the market. And at this point in time, if you are looking at your chart pattern, it tells you a particular high trend in the market that shows either a breakout in a fall or a breakout in a rise on the trend. When this comes out, it indicates longer movement in the market, which is a high probability trade for every trader. And I would like you to always master these pieces. Now, as we go further, when you keep reading into or go through our library, the different books you see there, you're going to see how you can actually trade using your head and shoulders. We also have the left shoulder and the right shoulder. Now, the left shoulder, like I said, we have the upper version and the downer version of these particular moves in the market, depending on how you're placing your trades. And this depends on how you view your charts. So at every point in time, when you want to view these different patterns, it depends at the peak at which you find yourself in the market. We have double tops and double bottoms. These are other key technical points that determine your profitability in the market. Now, double tops indicates how far you can go deep in the market when selling, while double bottoms determine a breakout in a particular trend that can potentially be a long-term trend or a long-term trade in the market. These top and bottoms give you high probabilities access to profit trading. And when you understand your key entry and exit point, then using your double top or your double bottom can easily make you rich just in a day. So I urge you all to actually understand how these work. We are going to look at this furthermore when we are taking detailed analysis into the technical aspect on trading. So I will simply want to explain detail what tops and bottoms are. These formations are similar to the head and shoulders formation, but there is no head. Just like I said in our previous chart, we have this head and shoulders, which are absolutely support and resistance point in another form, which gives you the probability to enter key profitable trades. We also have the top, the double tops and double bottoms. When you keep trading as a trader, as you keep being friendly on your charts, you get to understand more on how these things are working, which I cannot really explain here, but we are going to have a time where we go directly into a live trading session. You see me actually manipulating and playing through all these different aspects as I explain here. Now, we have triangles. Triangles are continuous formation. The three flavor, we have the ascending, descending, and symmetrical triangles. Typically, triangles should break out about a half of 3/4 of the way through a formation. Now, just like we have uptrend, we have downtrend, and we have symmetrical trends in the market. An uptrend will obviously have triangle formations. And before you have a breakout, then you should be able to draw your triangle formations. Triangle formations indicate a persistent breakout in a particular trend, be it up or down. And as you trade at every point in time, before you enter a buy position or a sell position, identifying your trend is one key aspect that you need to take into consideration. Once you identify your trend, forming a triangle is always very important, because you're going to indicate or know if we have a breakout on that triangle or a resistance point. These are key points that enables you to have an entry and exit path in the market to give you better access to profitability. Take note of this. As I round up with this particular course, I want to urge each and every one of you, trading is not just something that you sit and you want to be a trader. It's a skill that you develop every day as you spend time on the chart. Just like every other sector in the economy or in education that you go to school, the best school when it comes to trading is your chart. You play with your chart, you understand the chart, why in the market, and you make the chart your friend each and every day. There are times that just seeing the chart makes me happy. There are times that just seeing the chart make me satisfied. And those are the moments I understand basically anything I have been facing difficulties in the market. So I want to urge you, getting to the forex market is not just something you sit one day and you just like, I want to be a trader. You make that reach, but you take consistent time to build yourself, gain the skills, gain the experience, and it's over time. You get to make mistakes every day, but trust me, those mistakes are the things that guide you on a day-to-day basis to be a professional trader. I don't want to tell you how many accounts I've blown, but trust me, I've blown a lot of accounts before being at this level. And I want to share with you, as you take a step today to build your trading career, have in mind, it is never too late. But one thing you should never give up in, once you blow your account, take a break, have a deep rest, understand why you make the error, get back to your demo account, do practice on it before coming back into your real life account. Now, it is usual that many a times people make errors because they fail to understand the different patterns in the market. I will not lie you to go through what I went through, because I want to share my experience with you. So join me on the other side of my decks and how I take you into some key aspects in the market that you need to take into consideration. Just like I said, your key entry and exit point in the market is what you don't need to play with. Your fundamental analysis, your technical analysis are absolutely the points you need to focus on. That is why I tell every trader, every newbies in the market, pay close attention to your entry and exit point. This comes with the support and resistance level. Once you understand how to play over your support and resistance level, then you understand the rule of the game. Remember, always prepare or preserve your capital. That is your number one game. Don't play with your capital. Use your support and resistance on point, and make sure your stop loss and take profits are being set in place as you move on. It's true, a lot of people don't love stop loss and take profits. I myself, I happily use that shit because I know what I do. It does not mean I don't use it at every point in time. There are times I don't sleep on my trades, but I put those things to help me maintain my profitability in my points or in my trades I set every day. Now, as you keep to build yourself or as you enter the market, one thing you should put in place is time management. Draw up a trading journal for yourself. Draw up a trading plan for yourself that can guide you on a day-to-day basis every day. This will help you map out what you seek to achieve in the market, be it profits or losses. But trust me, we all want to make profits in the market, and being your mentor is here to help you make the maximum profits out of trading time in the market. I am Amini Chair, the number one forex master, and I'm here to guide you on a day-to-day basis on how to make consistent profits in the market. Don't go without subscribing to our link below to make sure that you follow every news and every detail as we pop up every day. Thank you.